Hey everyone, welcome back to another episode of Acquisitions Anonymous, the internet's number one podcast about buying and investing in small businesses. I am your host for this week, Bill D'Alessandro, and I am really excited to introduce this week's episode. This week we have Mehtab Bogle from Karta Ventures. And Mehtab and Karta are specialists in e-commerce, direct consumer, distressed acquisitions and turnarounds. I've gotten to know Mehtab over the past couple years through the e-commerce fuel community, and he and I have become good friends. And I'm always so impressed with just how savvy he is. And he takes us through in this episode the ins and outs of a bankruptcy auction, and we do it through the lens of a cosmetics D2C company that is going bankrupt right now. And because bankruptcies are public, we are able to use names and real numbers. So I think you will really love this episode with Mehtab Bogle from Karta Ventures. But first, a word from our sponsor.
Hey guys, Michael here. Want to talk to you about one of our sponsors in our never-ending quest to make Acquisitions Anonymous break even. And that sponsor is cloudbookkeeping.com. It's actually run by my neighbor, Charlie, who's a great guy. And he has been our longest tenured sponsor. And we're super grateful for him to support the podcast. So what Cloud Bookkeeping does, it is a set of cloud bookkeepers that if you're a small business person, help you get out of the business of doing your books and let you focus on the business of taking care of your customers. So they do all the complexities, bookkeeping, payroll, and they come across and are very client service first. That's their phrase, but I know that's true because I've spent time with Charlie and dug into their business. So full suite of accounting services, sophisticated reporting, QuickBooks software solutions, and full service payroll options. So definitely talk to Charlie if you want to get out of doing bookkeeping and outsource that to a trusted third party. And you can find them at cloudbookkeeping.com. So thanks again for sponsoring today, cloudbookkeeping.com.
All right, I am here with Mehtab Bogle from Karta Ventures, and Mehtab and I have gotten to be good friends through the e-commerce fuel community over the last couple years. He is one of the smartest folks in e-com I've ever talked to, and it's fascinating because he specializes in turnarounds. So distressed e-commerce companies, he comes in and acquires them, and we have got some very interesting perspectives from him today. So Mehtab, great to have you here, man.
Yeah, no, great to be here. Thanks for having me.
Can you give our listeners just a little bit of background on you, Karta, what you do?
Yeah, so I bootstrapped a few D2C brands in kind of my early 20s. I started making angel investments, actually tried sourcing deal flow on Reddit, and then I met my business partner there. We invested in a handful of companies together. He'd done some turnaround before when he worked for CSC Generation, and then he dragged me into doing turnarounds. So here we are.
So do you guys have a fund? Do you raise deal by deal? How's it structured?
Yeah, we're more of an independent sponsor, so we do raise on a deal by deal basis. We'll usually actually just put all the equity up ourselves for any sort of transaction that we close, and then we'll bring investors in later, if that makes sense. That just allows us to move much, much faster, given you're essentially paying more for the asset if you wait. So
Yep. In distressed, time is money. So can you tell kind of target wise, what size do you guys typically look at?
yeah, we really want anything we can carve down to about 2 or 3 million in EBITDA. I've just found you're going to end up doing the same amount of work anyways if the deal is smaller, um, and there tends to be more going on the credit side the larger the deal is. It doesn't mean we won't look at smaller deals. It's just that's where it becomes a little bit more appealing for us. So
So 2 to 3 million in EBITDA probably leaves you around 20 to 50 million in top line ballpark.
yeah, and then we have to carve that down. So we always obviously it's much easier to bring a company down in size than it is to grow top line revenue. In e-commerce, especially as you tend to shrink size, your cost per acquisition goes down on the customer acquisition end. So it's a nice little dynamic if you find something that looks like it can be downsized cleanly.
So I want to expand on this a little bit because a lot of people might say you buy a business and then you downsize the business and you aim to shrink revenue. I'm guessing this is because, as a fellow D2C guy, in direct consumer or in any kind of marketing driven business, your incremental customer is the most expensive, right? To
Yeah,
acquire
yeah,
one more
absolutely.
customer is the highest CPA. So I imagine what you're doing is sort of shaving off those highest CPA cohorts, right? To get down to the profitable ones.
Yeah, just like you said, the last 10% is always the most expensive. So shaving that away, getting back to kind of the core customer, and cleaning up the company buys us a bit of obviously the less revenue there is, the less need there is for kind of additional overhead expense. So.
Yep. Yep. So tell me, can you tell our visitors sort of what's the portfolio at Karta look like now? You can be as specific or as general as you want.
Mhm. Yeah, so there's three primary platforms. One's a succulent company, completely vertical. So we have 24 acres of farmland out in the middle of nowhere, California. Uh, and that means we grow the plants, pick them, ship them to the end customer. That's nice because it keeps the typical e-commerce guys out. I certainly don't want to be bidding against some of these guys who are really, really strong on the marketing side. So that gets around that. They're not going to boot up a farm in the middle of nowhere. The second platform is a floral company that makes artificial flowers made of wood. That one's interesting too because it has a really complicated supply chain as well as a bit of a US manufacturing dynamic. So we have about 100 people on the manufacturing side out in Utah, which is where I am right now. And the third platform is a fast fashion women's clothing company. That one's a little bit more straightforward. It's just interesting because the fast fashion side, there's a bit of a logistics play there, if that makes sense.
Yep.
And then there's a handful of minority equity investments where they're either completely hands off or we're involved, but not. It really depends on the specific position, but there's nothing we're overly involved with right now.
So will you guys, is your general thesis to buy it, fix it, and then sell it once it's stable, or do you try to hold for a while?
Yeah, I guess it depends on the underlying asset. The floral company, for example, our intention is to hold that for quite a while. Really, just keep picking up the low hanging fruit. Um, until we feel that's done, we don't really want to sell the company. Even then, we'd rather just pull cash out of companies to make new acquisitions. In turnaround and distressed, I guess it's unique because you don't need much cash to actually get a deal done, especially in D2C where there's no real competition. If you look at industrials or something else like that, there is a roster of turnaround operators and turnaround focused private equity firms that an upside down lender can go to. In D2C, there's no such thing. So there's really not much competition. Assets don't get bid on much unless you maybe go past the 100, 150 million range in revenue. Um, Even then, it's a pretty dead market. So cash isn't really the concern. It's more so of a bandwidth thing, if that makes sense. You kind of end up paying in blood. So.
Yep. So help me zoom in on that a little bit because sometimes when I think about turnaround, I think about, cash is king, right? These companies are bleeding cash. Liquidity is
Mhm.
often the problem. If you can come in with cash and kind of recapitalize the company, that often stabilizes things right away. Can you kind of zoom in and explain to people, maybe what the cap structure looks like before close and right after close, and why do you say that you don't need a ton of cash?
Yeah. So typically, if you're looking at a company, let's just use your average company doing 15 or 20 million a year in revenue, um, and let's assume they're both. It's an income statement and balance sheet turnaround. So maybe there's some very large liabilities coming up that they're not going to be able to meet, and there's kind of ongoing cash that they're hemorrhaging. Uh, in that scenario, um, coming in, turning off the bank. Sorry, as far as entry and the capital stack. There's usually a senior secured lender, and then you'll see someone kind of junior, more unsecured lending against the cash flow. You probably won't have like a second lien or third lien lender or anything like that. And then you will have a handful in e-commerce, especially. You'll have a handful of these programmatic lenders, so ClearBank, maybe Wayflyer, maybe like a Shopify Capital or the Amazon equivalent, or some of these. PayPal Capital is another good example, and those are all unsecured in most cases.
So to those guys, does the unsecured folks, you come in and you basically approach the secured folks and you say, look, this is on the edge of bankruptcy. Take a haircut, and then you go to the unsecured folks and go, this is zero for you. Sorry. Is that typically how it goes?
I guess it depends on the specific deal. With secured, they're typically going to want out of their position, and that tends to be the most logical way into a company. So you can offer them a certain percentage. So maybe they have. I'm just using really simple numbers here. Maybe they made a loan of $10. You might offer them $2 for the position, and that will basically essentially get you control of the company in some cases, and or whatever the fulcrum ends up being. The fulcrum's just a phrase for whatever converts to equity and lets you control the company. A lot of these cap structures are pretty simple compared to what you see upstream. So, anyways, you come in, maybe you take over the senior secured position, and you end up owning the company. From there, there's the unsecured lenders, et cetera. Some of them will be critical vendors. So, Facebook, for example, you don't want to default on. You can't be a D2C brand without access to Facebook. Same with Google, and then a handful of others like FedEx, UPS, et cetera. Anyone that's not critical, we'll typically work with the unsecureds to build out a plan. We'll walk through them. We'll walk them through what a subchapter 5 bankruptcy would look like. Um, and subchapter 5 is a very, very interesting tool. It was just came out about, I think, 2020, right before COVID. And it's basically an inexpensive version of Chapter 11 for small businesses with under 7 million in debt. So
So do you typically you come in, you offer the senior guys 20 cents on the dollar, and they say, yes, we want to take that. Do you have to, is it a separate transaction wherein you take the senior guys out and you actually have to put the company through a bankruptcy process in order to take the equity? Or do you just go to equity and go, look, just hand us the keys. It'll be less miserable for everybody.
yeah, it depends on what the structure of that loan looks like. Sometimes it's easier, other times it's not. We try to avoid anything that looks like it's going to require protracted legal work on entry, if that makes sense. Typically, the equity is on board with what's going on, and we can convert. You know, if the founder's still around, we're happy to, if it makes sense, and if they're the reason the company is distressed. Uh, then we're happy to keep them around. Like the one of our platform companies, we have both of the original founders around still because they do a good job, and it wasn't really their fault that they were distressed. So
So when you say the equity is usually on board, when I think about distressed or bankruptcy, on board means accepting of a zero. Is that always the case, or do you try to leave the equity guys in order to get them to commit to this transaction some bite of the apple and upside? Is there a way to structure that?
yeah, essentially granting them equity in whatever the post transaction company or entity looks like, and having that vest. If that makes sense. Obviously, they're not going to go back to owning, you know, the entire company or a big chunk of it. They'll still have some upside. They'll still have a salary in some cases. So it's a lot smoother for their personal finances.
Okay, so you convert them from kind of a founder with a lot of equity and very volatile
Mhm.
salary to essentially an employee with option grants, right?
Yeah,
With a
yeah,
small
exactly.
stake in the upside.
And we found in a lot of cases, people do want to make sure that the company um, kind of gets through things okay, as opposed to, hey, you know, let's burn everything down type of thing with their exit. They realize they're upside down at that point. It's a little bit different from. It can be different. Some people are very, very delusional, but we try to stay away from that. And it really depends on the upside, I guess. Maybe sometimes we're happy to look at it, even if they are delusional. It requires a little bit more legal force. But
Legal force. I see deals sometimes where the equity is delusional about the value. And
mhm.
my typical sense is, okay, call me back in 6 months. Maybe you're right. Maybe everything's going to be fine and it's going to be worth $1 zillion. Call me back in 6 months if I'm right. Is that
Yeah, yeah,
often how you
exactly.
guys play it?
Yeah, I'd say we some of these companies we end up starting to talk to them. A good example, actually, we're looking at a company that we ended up making a loan to in Q3 of 2021, and then Q1 we ended up making the loan, and they were just a little bit more confident in their turnaround than we were. But we told them we're happy to kind of provide you with liquidity to get through this and give you guys the tools. It was a really solid operator. He did a really good job, and we were kind of happy to loan to the company.
So you just mentioned making a loan. Are you guys, so that would be a debt instrument. I had assumed you guys were always equity investors. That seems to not be the case. How do you guys think about, is it like loan to own in some situations, where it's essentially, if they're right, you just make a nice current return on your debt. And if you're right, you own the company?
Yeah, it's a mix. I guess it really depends on how good we feel about the founder. In some cases, uh, what we'll typically do is we will write the debt. It'll be senior secured, whatever, first lien, um, and they'll have some level of pseudo secured debt on their cap table. What we've noticed actually happens quite frequently is you will see that certain creditors have the right to file a lien, but that doesn't really mean anything because you have to perfect a lien before it's actually legally gives you priority. So whoever perfects first is the one with actual priority, and we're usually first. So that'll happen, and then we'll help them start just our implement our standard tool set. It's fairly straightforward. Get a 13-week cash flow model going, starting to push some vendors for net terms, et cetera. And that'll usually create enough cash to get them through the hump that they're going through. And then we'll help them get more unsecured debt. And that essentially builds a liquidity moat around us. So we're essentially guaranteed payments, if that makes sense. If they do default, there's usually an asset there that we'd be happy to own. So
Yep. I've always thought, and it sounds like you're you're circling around this model. There's such a dearth of debt capital for
Hmm.
mid-size e-commerce businesses, and I think it's because banks can't get comfortable with the underlying collateral. Right? They're not really cash
Right.
flow lenders; they're asset-light businesses, and the bank doesn't want to own a succulent farm in the middle of nowhere with the primary go-to-market as direct consumer. Right?
Right.
Um,
Yeah.
but if you were D2C savvy and you didn't mind owning the asset if it didn't go well, it would
Right.
probably allow you to get a lot more comfortable with a lot different credits that there's not really
Yeah.
markets for right
Yeah. Exactly.
now. Okay, cool. So you brought a fascinating deal, a public bankruptcy from earlier this year that you and I chatted about in January, and all the details have come out. So we're going to walk our listeners through this deal. And the cool thing about public bankruptcy is that all the names are public. All the whole situation is public, and we can talk about all the numbers and the names, et cetera. So I'm going to read a little teaser, and then Mehtab, I'll throw it over to you to kind of frame the financial situation that they were in, and then we'll get into how we would look at this as investors. Um, so our subject today is a company called BH Cosmetics, which is a leading direct-consumer color cosmetics brand focused on the millennial and Generation Z customer. It was launched in 2009 with a focus on eye palettes and has since developed a full suite of high-quality color cosmetics, including products for the face, lips, eyes, brows, and brushes and accessories. They have a worldwide social media following across multiple platforms and utilize a deep influencer network to drive brand awareness, trial, and customer acquisition. We will get back to that deep influencer network in a minute. Given the company's heritage, BH has developed an advanced e-commerce platform with proven capabilities. And so BH was acquired by a private equity firm called MidOcean Partners in December of 2017. Um, so MidOcean, they don't just do consumer; they do a lot of different stuff. Legitimate private equity firm. They put some debt on it when they bought it, and by the time so they bought it in 2017, and it did not take long for things to unravel after that. So Maytab, can you kind of take our listeners through what happened after MidOcean bought it?
Yeah, so it looks like MidOcean purchased it. Shortly thereafter, the original founders left. They swapped in a new CEO, and they ended up having to push debt back, I think, in 2019. Yeah, so the first forbearance started in February of 2019, which is also when the founder and CEO resigned and an entirely new management team was hired. Obviously, things didn't get better with COVID. So COVID happened, and makeup in general is a different vertical. Sorry, a difficult vertical to make work, and it gets even more difficult when COVID happens. And from there, things slowly deteriorated, and eventually they filed for bankruptcy. I think Q4 of 2021 or Q3, and Q1 of this year, 2022. The asset was finally sold via 363 auction for the essentially the IP, really.
So Maytab, can you do you have numbers on kind of revenue
Yeah.
trajectory?
Yeah.
What were those?
So pulling them up here. So 2019 was 55.8 million in revenue. 2020 was 33.6 million in revenue. 2021 through November was 18.6 million with negative 14.4 million of EBITDA. So
Whoa, negative
um,
14 million of EBITDA on 26 million in sales.
yeah.
Um, do you have more detail on where the hell all the money was going,
uh,
or
so when
not?
I looked into, I pulled up. This is kind of a funny way of doing it, but I had just pulled up LinkedIn, and I used the little graph that they have to go further back, and it looks like they had quite a few staff still. It almost feels like they were geared up to run a 60 to $100 million company as far as staff goes, and kind of the way their setup was, instead of a company doing 20 million, 15 million. And I get that because they're distressed, but they've been distressed for a while, so I think they're a little bit slow to start making cuts.
Yeah, I would say so. And there was a crap load of debt on it. So
Yep.
the article you sent me said that MidOcean acquired it with a $25 million credit agreement
Mhm.
from Fifth Third Bank. And there's about 21 million currently outstanding, and it started to go into forbearance in February of 2019. So that is less than 18 months after MidOcean acquired it.
Mhm.
So it did not take very long for things to start to unravel. Um,
No.
and it looks like MidOcean continued to inject equity even through the forbearances. Is that right?
So yeah, MidOcean initially purchased 60% of the company in Q4 of 2017 more of the company in 2018, 2019, 2020, and 2021. So overall ended up being about $32.5 million in equity. This is interesting because you'll often see private equity firms um, kind of play games or let the company go further along into kind of an approach bankruptcy. My guess is that they felt they could float it through COVID and things would back up post COVID, but obviously COVID lasted a little bit longer than people thought. Otherwise, you normally see more games being played with lenders, being more aggressive, pushing back on debt, etc. So,
That's wild. So they're in for so Midosh is in for 32.5 million of equity, and the lenders are in for about 22 million of debt.
mhm.
And the thing has fallen from 55 million in sales to about 15 million in sales in 2021 was what they were tracking for. And then
Yep.
they filed for bankruptcy. You said in early 2022,
It was late 2021,
late
and
2021.
then yeah, and then the sale was completed. They ended up selling the assets via 363, I think, and someone purchased it. Well, not someone. I think they were German or UK based company purchased it for around $4 million. So
Wow. Okay. So let's kind of dig in for how you, as a distressed investor, they file for bankruptcy. What is a 363 auction?
yeah, essentially, it allows you to bid on the assets of the company without worry of another lender or someone else coming in and claiming that those assets were fraudulently transferred to you, and you would lose those, right? So, if a company is distressed, let's say Bill made has a lien against those assets, and they were sold off anyways to me, and I never bothered checking to see if there were any liens or anything like that. I purchased them. Um, Bill could allege that that was fraudulent conveyance, that they were transferred out fraudulently, and he could essentially get the assets back, and I might just be completely out of cash. So I wouldn't get any cash back. So
So the
360.
363 auction gives you comfort as a bidder that you
Mhm.
can acquire these assets free and clear.
Exactly, and that's court enforced. So.
And I assume there are brokers that, or lawyers or some clearinghouse that kind of takes you through this process.
Yeah, yeah. So typically, it depends. There's a few players for distress deals. You obviously have just straight up lawyers that are specialized in restructuring, bankruptcy, etc. You then have investment bankers who are specialized in the space as well, and they'll pop up kind of closer to the I'd say really 40 to $100 million range is where you'll start to see them. I'd say 40 million even feels small in most cases for them. So you might see them here and there, and then you'll see a lot of consulting and turnaround based firms. So in this case, they brought Riveron in, which is really interesting. We actually the first QOV I ever had done was from Riveron. So it's funniest thing. I didn't even realize they had a restructuring practice, but I guess they do. So they brought in a someone from Riveron's team to essentially manage the company through the sale,
Okay.
and that's what we saw here.
So take our listeners sort of through the process. So the company decides,
Mhm,
okay, we're actually screwed. We need to go through this 363 process.
mhm.
Um, I assume there is, like an information packet that goes out to, a little bit in advance to help bidders kind of get comfortable. And then is there a literal live auction like on the phone?
There's so in most cases, what'll happen is you'll have a stalking horse bidder who basically sets the floor for the auction, and they're compensated in some way for doing that. So in this case, there was an actual fee that was paid to the stalking horse bidder. It can be quite lucrative if you're willing to just kind of go out and make a bunch of bids, uh, and they essentially get an advantage, and they're incentivized to kind of follow through on the bid if that makes sense. So in this case, they set the floor, and then there's a period where people are allowed to make offers on the asset being put up, and yeah,
Okay.
that's essentially it. It's fairly straightforward.
So your Carta Ventures, you specialize in distressed ecom. This deal comes across your desk, right?
Mhm.
The revenue is a falling knife. There's a ton of equity already into it. There's a private equity into it, and there's a bunch of debt on top. How do you start to think about an opportunity like this from a diligence, and then what structure will we propose? Kind of take us through your mindset.
Yeah, so we like to break a company out into its parts and see what it could look like post transaction. We actually build out a 13-week cash flow model based on financials that we have available. Um, to sketch out what it might look like if there wasn't that massive debt load sitting there, if certain economics could be improved, right? Like maybe they implement lean manufacturing, they cut variable labor. Obviously, they're not manufacturing in this case, but if it was a company with a manufacturing component, you implement something like lean, you can cut variable labor costs by 40%. You can build that into your 13-week cash flow model and see how that flows. And that all creates room for payments to lenders. And you can show that to lenders, right? You can say, hey, look, here's what we did elsewhere. We could do that here. This is what your repayment would look like. And it often comes down to convincing the lenders. And then obviously there's the legal side to seeing what can be pushed back, what can't be pushed back, how flexible are certain lenders. In most cases, lenders do not want to be the ones to run the asset. Just given their lenders, they're not equity. So uh, that's our approach at a really really high level. And looking at the liquidity within the business, in a lot of cases, someone is distressed and thinks they don't have enough runway, but they really do. They're just not pushing for as much float as they could get. So maybe maybe they have a large Facebook bill, they're paying $1 million a month for Facebook ads, um, and for some reason that bill's still being paid via credit card when they could push Facebook for net terms. You can actually pay Facebook 19 days late. They won't ban you until the 20th day. So you essentially get your net 30 plus another 19 days on top of that. So you just created 19 days of whatever that ad spend cash is, if that makes sense, within the business to use as working capital.
So you come in, you're looking at the income statement to try to figure out where we can reduce expenses, be it at the very highest level, interest and amortization expense.
Mhm.
But also, are you looking at, are there too many people here? Or, do you know the business well enough to know that at the bidding stage?
Um, So for the smaller companies, we'll typically have full financials from the that the lender will just shoot over that they have, and we'll rebuild everything. We'll build a 13-week cash flow model to make those decisions. We'll look at staffing and see how heavy it looks. In most cases, once we're actually there or right before we're there, we can tell. It's fairly easy to tell. I think the biggest giveaway is looking at the reporting structure of each department and how that flows. It'll typically tell you how well run a company is or a specific department really quickly. We've seen all sorts of ridiculous things. I think my favorite of all time is still the accounting department that had a bunch of people in it where nobody was actually using Excel. They were they're manually entering numbers. They'd have a calculator, they'd calculate, say 2 plus 2, right? Equals 4. And then they would type that into Excel instead of using a formula.
Oh my God. And had no one told them that Excel had formulas? Was that the basic idea?
Uh, I guess, essentially, I guess. So they're very fat on staff, right? And we'll see a lot of that. Another good example, customer service. All D2C and e-commerce software, well, not all, but most of, it'll show you how many tickets someone's gone through, right? So say Bill and I are both customer service. We both do an average of 100 tickets a day. We go on and we can see Girdley's only done one ticket today, right? And it's like, hey, what's going on? Explain this.
Right.
And there's usually no explanation. They're just kind of lazy and no one's ever looked at it. So
Yep.
it's pretty clear what needs to happen. Or in some cases, they have large US based staff that does not need to be US based, right? And that presents massive cost savings opportunities. So,
Okay. So, and then how do you think about, you're going to go to the senior lender here. In this case, for BH
mhm.
Cosmetics, there's $23 million or so of debt on it and 32 million in equity. Let's say you run your 13-week cash flow model and you go, okay, like we think we can make this work if there was no debt or minimum amortization. We move some people to the Philippines and we fire Michael Girdley because he's totally dead weight, et cetera. Now you got to go to the lenders and the equity holders and make a
Mhm.
proposal. So how do you decide, hey lender, it's 80 cents on the dollar, hey lender, it's 10 cents on the dollar? And do you have to talk about amortization periods, new interest rates? How do you come to the proposal? Because your bid isn't just it's $4 million. It's much more complicated than that because there's a whole deal structure and how we're going to do the workout terms with the debt. So how do you wrap your head around what you're going to propose?
Yeah, so there's kind of two main scenarios that you see in distress. One's pre-bankruptcy, so maybe they're very close to filing for Chapter 11. In this case, they filed for Chapter 11, then ended up doing a 363, which is essentially you're liquidating the company. So it more or less turned to do Chapter 7, right? Maybe they should have started there, but they still felt they could bring the company back. So if it's pre-bankruptcy, that's where you tend to see most of the negotiation happen. If something's still sliding even through bankruptcy, everyone kind of knows it's a write off at that point. It's just a 363 bid, which is very straightforward. But pre-bankruptcy, like you said, there's extensive negotiations with the lenders. So we'll go to them, show them what we think can happen, and come in fairly low. We like a nice moat around anything that we do, and you really never know what's going to happen, right? Like in our case, we purchased that floral company. 75% of the customer base was bridal, and then COVID hit. We were lucky because the asset was really scalable, so we grew through COVID. But if it was something that maybe wasn't as scalable or there was as much low hanging fruit, we may have just kind of slid down, right? And then the same deal with the creditors in that deal, we were able to just kind of push them aside more or less. Um, so yeah, I guess it really comes down to the specific asset. I'd say with D2C, it's really interesting again because there's no go-to bench of operators for an upside down lender to go to. There's no one really specialized in turnaround, so we can come in with a fairly low bid if that makes sense. They're very happy to get anywhere from kind of 10 to 30 cents on the dollar would be considered a very good outcome for them.
Okay. And it just depends on if they've already gone through a bankruptcy process and it's in
Mhm.
363, they've already agreed how they're going to divide up that 10 to 30 cents on the dollar.
They're done. They're just going to be paid with the proceeds of the auction, if that makes sense, going
Yeah.
through seniority.
Yeah.
So,
They've already thought
um,
about who's senior, who's sub,
mhm,
they already know what the waterfall is. But before bankruptcy,
mhm,
that's when you maybe have to be a little bit more creative and get the lenders to let you agree to throw equity a little bone, right, to get it
mhm.
done.
Yeah, and in some cases, if there's a fulcrum security or there's multiple lenders, um, you can essentially buy a position and use that to make a dip loan as part of the dip loan, if that makes sense. And that's a debtor
What's
in
the dip
possession
loan
loan.
for our listeners?
Yeah, it's a debtor in possession loan. That gives you super priority over everything else, so that you can actually cram down. So if you're senior secured, you're the bank. I come in, I'm the one that's actually willing to make the dip loan to the company. I can cram everyone else down. So
So you can come in at
basic.
super senior secured ahead of everyone.
Yeah, so in most cases, you'll see the senior secured lender make the dip loan themselves, and the terms on those can be pretty crazy. I think shot you one about a year ago. I can't remember who it was for, but the uh, the dip loans tend to have pretty wild terms in them. So if a company misses a payment, more or less the dip lender then owns the whole company, or you'll see some pretty wild interest rates. Even on the larger side for some of these companies that are in all reality a pretty safe loan. Um, they're being charged anywhere from kind of 14 to 18% once you factor in fees. Obviously, with a smaller company, it's even higher than that. So it's a very safe loan to make.
So the thing that fascinates me about this whole world is, if you're listening and you're an investor, right, you probably think, wow, like the rates of return on these loans are fantastic. Like there's such huge opportunity here. From a spreadsheet perspective, I can do all these fun spreadsheets that really make great IRRs. But ultimately, you have to be willing to own the company and run it, right? Like the downside, the threat of the dip loan is that they default. And then, oh crap, you own it, right? And you've got to
Yeah.
run it and your principal's at risk. And if you don't run it well, you lose principal and plus all the legal fees. There's a whole, you kind of don't want to get called on your bluff in a lot of these scenarios, right? If you're the stalking horse bid or if you're the dip loan, and then oh crap, you own the business. And that's what has always fascinated me about your business at Karta is that you guys are extremely financially sophisticated on the front end from an investor point of view, but also you're not afraid to own the asset at all, right? I mean, you mentioned you're operating several companies right now.
Yeah, I'd say we're probably stronger on the operating side than the financial side too. So, for us, part of how we look at our moat and kind of margin of safety is what we can do on the turnaround side around ops or helping the company with turning, with just implementing a few basic changes that would create plenty of cash for them. And again, just a moat around the loan if we did make a loan, or a moat around our investment on the equity side.
When you say moat, you mean margin of safety?
Yeah, sorry. I'm just using them interchangeably. So,
Sure.
a few things can go wrong and we won't necessarily be completely upside down. Whereas if someone was just coming in on the financial side, they can't build that, right? That extra layer of protection. So in this
Mhm.
case, we might say something like, hey, implement EOS, implement lean, implement top grading, etc. And you'll see X, Y, and Z improve tremendously, or make these cuts and you'll free up enough cash to where suddenly the debt load isn't really that big a problem.
So let's talk a little bit about the operations side because you've dropped a
Mhm.
couple breadcrumbs during this interview that I want to go back to. So you mentioned with your wood flowers business, you said it was 75% bridal when you bought it, but then you said, but the asset was very scalable. So we actually grew through COVID. So that's obviously a post transaction operational win. So can you
Mhm.
kind of walk folks through what happened in that scenario?
Yeah. So the company had scaled really cleanly, more or less organically. They weren't really doing much. So they were spending on paid, but it was literally someone who had absolutely no clue what they were doing, just buying Facebook ads. It was wild that it certainly wasn't working. Like the paid ad side, the organic side was working ridiculously well, and the paid side was just burning money, right? So just fixing that alone was a pretty big win. The website, for example, complete garbage. It looked like a 15-year-old had made it or something. So just ripping that out, replacing it. On the ops side, they were actually the ones with a customer service agent who had answered, I think, one or two emails through the day. We brought her in and we're just like, "Hey, can you explain this to us?" She said, "No." I said, "Great, get out." Other good examples on the production side, they had people there. They had a guy who, this is the best story, just sounds completely made up. He claimed he had epilepsy. The previous owner was paying him under the table and he wore a kilt every day. And he had a bunch of knives like strapped to his calf. And
Knives, real knives?
yeah, yeah. I just thought it was the weirdest thing, and I was like, "Okay, well, this isn't gonna work. You need to go." And just a lot of similar situations where there were people that just I really couldn't figure out what they were doing. It didn't make any sense. So, a lot of these tend to be more black and white than you would think. Probably the most hilarious it's just weird to me that this actually works. It's bringing everyone in, just saying, "Hey, who do you think does a good job? Who does a bad job? Do you mind walking me through what you do? Where do you want to be, etc." Almost like a re-interview, but getting feedback on the rest of their colleagues tends to be strangely consistent. So if you have a team of, say, let's pull a marketing department out, and there's seven of them, right? If you talk to them, you'll typically hear that the who the best people are, and everyone will say almost the same names, and same deal for the worst performers.
Mhm.
And that lets us make decisions really fast within the week. In turnaround, it's a lot like running a startup. You have to be willing to make big decisions really, really quickly, and those might not be the right decisions in most cases, but you need to move fast, otherwise you'll be out of cash. So
Yep.
it's with the floral company, I think I was personally losing about $6,000 to $10,000 a day. So that's a nice fire under your ass to move a bit faster.
Yep, that'll motivate you. So
Hmm.
for you guys, because you are direct consumer experts, and those I assume are pretty much the only businesses that you will bid on in distressed situations, because you're not
Hmm.
afraid of owning them. I
Right.
imagine when you run your 13-week cash model, let's say I start up, Bill Ventures, and I want to bid against you.
Right.
Um, but let's say I'm not me, I'm just a regular financial guy, and I don't know anything about
Uh-huh.
D2C. Um, and I bid against you, my 13-week cash flow model or my projections for the company will probably be fairly muted, right? Because I don't really know much about this industry. I don't know. Maybe I got to bring in a CEO and hope he can turn it around, et
Right.
cetera. I would imagine that. So I'll only bid so much, right? Because I'm
Mhm.
pessimistic to average about the future of the company. I would imagine that you guys can come in and say, wow, like these Facebook campaigns are just lighting money on fire, but over here, if we scale these up, we can really grow this business. So I imagine that being a really good D2C operator allows you to develop a more optimistic lens on the future than other bidders might, and therefore bid a little more, even $1 more. Do you find that happening, or are you just very frequently the only bidder anyway, and it doesn't matter?
I'd say more often than not, we're the only bidder. Sometimes there is another bidder, and they might be more optimistic than we are. I've actually found it goes both ways. So either they're far more conservative or they're far more liberal with their projections. And it'll be the finance guy who hired a consultant from a marketing firm. The marketing firm, like, yeah, oh, totally, we get this pumping in a 10x ROAS. And that's just not realistic, right? It's not going to happen. Your CPA is going to go up 20% a year no matter what you do. So you need to account for that, et cetera, and underwrite to that. But um, a lot of these guys will just drink the Kool-Aid that they're being told from these agencies. So that is one advantage we have. Those we can move much faster on the diligence front, which tends to be the main selling point for a lot of these firms. Is hey, someone else might come in with a higher bid, but they're going to come in with a higher bid once you've lost another $3 million. So if you we can move really, really fast. We can run the diligence ourselves with our in-house team. We can have someone poking around in the accounts tomorrow. We can have someone else, building out the 13-week later today, um, versus a private equity firm that can't really do that because they don't have an operating team with deep, deep distress turnaround experience on D2C specifically. So.
Yep. So what are some places when you talk about going quickly in diligence for you? And this is different in every industry,
Mhm.
right? But for you guys, can you think of like one or two things that you dig in much deeper on, and also one or two things that you don't give a crap about that everyone else seems to care a lot about?
Um, I guess it really depends on the specific transaction. The thing that really concerns me most of the time is the product and the product team because that's outside of the everything tastes like chicken layer, right? Everything else about the business is more or less going to be the same, but the product and the dynamics and really understanding everything about that and what the team looks like post purchase is really critical to us, especially if we're going to be losing the founder in the transition. They tend to be very product focused. They know the product side and the customer really, really well, and there's no way we can replicate that ourselves, right? Like I can't come in. I'll give you a good example. I've only been to maybe two weddings, like two American style weddings in my life. I'm 28, so I don't have that many friends that get married yet. But the I really didn't know anything about weddings, so I know I can't come in and build a lineup of flowers that look good for weddings, right? We needed someone solid on the product side. So that's where we run the deepest diligence and making sure that there's someone around or a team around that can handle that properly. And then going back to mechanics, yeah, I'd say probably really thinking through the customer acquisition side and stability around that and ensuring there's no little tricks like, you'll commonly see the email list just being blasted. In some cases, that's okay if it's a certain audience where they don't mind being blasted, but in other cases, you're going to burn the list fairly quickly, and you'll see performance just drop off a cliff on the revenue side. So, um, same deal with paid. There's a lot of little short term tricks you can use, right? So,
Hmm.
making sure none of that's going on, really. Outside of that, it's just diligence and what the liability side looks like and ensuring we're not stuck with something. There's always surprises, I'd say, especially with turnaround, right? You never know what we're going to get. For example, we had a wood shop manager that ended up being on OnlyFans. I was like, oh, okay, I don't know what to do about this, but the uh, there's always stuff like that. It's not really a big deal though. For us, just ensuring there's no major liabilities sitting around that'll bite us.
Yep. If you've heard the term like desk drawer liabilities for like, secret or undisclosed liabilities, that actually
Hmm.
happened to me. We bought a business in 2017. It was distressed. Um,
Hmm.
and they were losing, I think they were losing about 50 to 100 grand a month.
Hmm.
And same thing, we came in, we basically got it for assumption of debt, and then did
Right.
work out with the lenders. Um, and when we got in there, I flew out there, companies in Portland, Oregon, flew out there, and we are basically going through the office because we were breaking the lease. Like we were out. And we were going through the drawers of the company's accountant. And we literally found $50,000 of vendor bills on paper bills that had just never been entered in the ERP. So there's no
Right.
way we would have known about them ever. And they were from, as you said, critical vendor. It was from the company's contract manufacturer. So we couldn't say, what I wanted to say was, sorry, seller, you didn't disclose these. These are your liabilities, which I had every legal right to do. But had I done that, seller would have just stiffed the primary manufacturer who I needed to keep doing business with. So we took, 50 grand in the teeth on that one,
Yeah.
which just
Yeah.
happens.
Exactly. Hmm. And in
Um,
a lot of cases, there's no real place to go and get the money out, anyways. Sometimes you can set up an earnout like structure, but in most cases, you're not really paying the equity tranche anything significant, anyways. So,
yeah, the classic phrase that, price is diligence, right? At a
mhm.
low enough price, you're willing to accept some body blows and just kind of add it to the purchase price.
Yeah, yeah, exactly. That's our way of looking at it. So,
So Mehtab, back to BH. So this one ended in a $4 million purchase of the assets. So new owner owns the assets free and clear. Do you think that was too much or too little for this business?
I guess it depends what the new owner feels they can do with the IP afterwards. Um, I think it was a little bit much, given it looks like the company's probably profitably only able to do 8 to 10 million a year, right? Maybe, and that's a stretch, right?
Yep.
Makeup, like you were saying, is a lot trendier. I think it's really rough because there's so many SKUs. I'm surprised when you Google the company, the reviews are actually really, really good. I'm surprised they didn't try to pivot into something else. I really like to treat these as startups almost. So pivoting a whole product line, moving away from makeup, to me, it's a total no brainer to try and give that a shot if the main business is crumbling so badly, right?
Mhm.
They did point to the whole no makeup trend as being a problem. I don't know if it's really a problem. I think it's a bit of a weak excuse. Um, the operator they brought in didn't really seem like he had significant D2C experience, plenty of retail experience, but it looks like to me that their plan for turning the company around, it really didn't make sense on multiple levels. They paid Doja Cat and Iggy Azalea um, for influencer deals, which is something you would do if you were a $100 million brand, but it's not something you would do if you're doing, 15 to 30 million a year. It doesn't really make sense to bring on that size of influencer in most cases. Maybe if you're profitable, you can afford to kind of take a shot, but it just seemed like a little bit of a Hail Mary. And I'm guessing the cash outlay for that was pretty significant.
Yeah, the thing is that is so we mentioned before we started recording how what a terrible business makeup is. People ask sounds like you, but also me all the time because we do personal care and skincare. Oh, well, surely you guys are interested in this makeup brand. I say absolutely not. The thing that's tough about makeup is you have tons of SKUs, right? All kinds of different colors and sizes. It can be very undifferentiated. You're not going to invent a new color, right? And colors are often seasonal. So you have to keep coming out with the new on trend color all the time. So your SKU churn is crazy, which leads to dead inventory, last season's colors that you can't sell. You also have to, every time you come up with new products, you need new photography. And if your photography has to be on a human face, right? Makeup's not very interesting if it's not on a human face. So you're always hiring models. It's hard to do all that creative generation. It's just a very hard business. And on top
Mhm.
of it all, price points are usually not that high, which is kind of death for ecom. Um, so in this case, the thing that was interesting is they got 3.6 million Instagram followers. Who knows if those are real?
Yeah.
But it seems that this brand actually has some recognition. So I would
Mhm.
imagine, whoever bought this thought, maybe there's something here that I can leverage, and these guys are just incredibly overstaffed. I mean, is that probably what they were thinking?
Maybe. Again, they just bought the IP essentially. So um, I have a feeling that that company owns a few makeup companies. I think was the deal with them. So or a few cosmetics companies, and I'm guessing their plan is to use an internal shared services team to basically relaunch the brand and get away with running it at lower volume. Um, Maybe it
Okay.
is profitable at that kind of $8 to $12 million range in revenue, and I would imagine the I forget how big it was. It was mentioned in one of the court dockets. But the email list is pretty chunky. Um, so there's something there. Like you can certainly squeeze cash out of it. Could you squeeze out 4 million in net profit within 2 years? Probably not. I think that's really hard to do, even with a shared services team, etc. They had some pretty real B2B accounts, but the margin's so low. It's so difficult in makeup because it's just commoditized, like you were saying. So
Yep.
um, I think 4 million is tough because you need assuming you had no shared services team that you could use to boot this up inexpensively, even then you're looking at a pretty significant outlay just to reboot, get something up and running, and then you have to build a business that flows cash, right? So
Yep.
you're
So,
in a difficult spot.
maybe as we wrap up, I'd love to kind of zoom in on how you think about return profile because what you just
Mhm.
described to me is I'm going to pay 4 million. I better be able to squeeze 4 million in cash out of this business in 2 years. But that sort of leaves aside entirely the equity value, right? If you've turned this thing
Right,
around and it's cash flowing $2 million a year, now some of that might have been balance sheet cash and might be one time or whatever. But
right.
ostensibly, you've created some equity value there, right? And there's some terminal value. So maybe these guys are thinking about it from that perspective. How do you think about it at Carta as far as I got to get my money back in cash, in balance sheet cash and operating cash flow in the short term? Or do you ever invest with a thesis on we can build huge equity value here and that's fine?
Yeah. For us, it really depends on the underlying asset and how we feel about it in 5 years. If it's something really commoditized like makeup, I don't really know how I'd feel about an exit. So I would want cash out of it within a year, um, 1 to 2 years, really. I'd say probably closer to a year for a deal like that. For something like our floral company, where totally fine not pulling any cash out of it, reinvesting really aggressively and scaling it aggressively, because we think there's this pretty good underlying equity value, just given there's no competition and net EBITDA margin could be quite high for that business. So same deal with the succulent company, really. Um, Compared to other companies where things are just a little bit more commoditized, it might be harder to scale. Obviously, certain businesses get really difficult once you push past a certain range and you go out of your core customer. So,
Hmm.
um, in that case, we like to think of it more from a liquidity perspective, and we do in all cases underwrite to liquidity to an extent, but we try to have our core cash back within 12 to 15 months.
So cash back in 12 to 15 months, and then sort of the enterprise value is your upside.
Yeah, yeah, that's the gravy. Or we can, if it's a company where we don't feel EV is going to be very high, maybe the multiple just won't be great because it's a shitty vertical. In that case, we're kind of okay with layering debt on and then using that to create cash to pull more out of it, if that makes
Okay.
sense.
So you
Basically,
essentially
substituting out.
sell the company to the lenders through a recap, effectively.
Yeah, yeah, essentially. And you're just layering that on as you go, right? As the company scales, it becomes more leverageable. A really good example is I think a lot of retail works that way, where it's possible to hold a lot of debt capacity. Same with some of these, like the fast fashion companies, a good example too, can hold a lot of debt capacity. And you don't actually need that much FCF as a percentage to pay yourself significant amounts of cash, if that makes sense.
Yeah. And are those businesses financeable because they're sitting on a bunch of inventory and AR? Is that what makes it
Yeah,
financeable?
exactly. And in some cases, you'll see really fast growth, but that growth can go away really fast too. So, um, yeah, like you said, there's the inventory side, and the inventory is, like you said, it's not succulents, right? Like I don't even know how you liquidate succulents. I don't know what would happen. So they can get lenders can get a lot more comfortable with something like jeans, right? Um,
Yeah.
than they would something like plants. Um, and obviously with scale, a lot of these programmatic lenders will lend against trend pretty hard. So if they see a company scaling quickly, they don't really care about the net profitability. They'll just write the debt.
Yeah. So you think about it, if you once you've got it turned around and it's scaling, you look at taking on debt in a way as monetizing your equity, while the trend is good. And if the trend turns around, it's debt. So yeah, that cuts both ways, but also, once you get money out of the company, it's out.
Yeah, it's also weird because it doesn't really cut both ways. With the programmatic lenders, they're all unsecured, so you can just push them back. There's actually no downside.
Yeah. So it's almost like a pre-sale of a small amount of the equity values. Let's just recap
Mhm.
it out right now. And if things continue to go well, that's great. We'll pay off the loan at sale, and we just got the money a little earlier. And if things go bad,
Yeah,
we'll just
yeah,
push them back.
exactly, exactly. So there's no real. It's kind of cool because there's no real downside to doing it.
Man, remind me never to lend you any money.
Well, that's like the unsecured programmatic guys who are a bit of a joke anyways, so
Right. Or yeah, they kind of in some ways deserve what they get
mhm.
for doing zero underwriting.
It'll be like PayPal. Like I've probably seen about a lot of PayPal defaults, and PayPal doesn't actually do anything. Obviously, you then lose access to PayPal as a payment processor, or you might. I've seen some companies. I was looking at a deal. They defaulted in I think like a total of 1.5 million in PayPal debt, and they still had PayPal on their website. I think it's two separate like branches, and they're completely separate from each other. So if someone defaults on that debt, you might not lose your payment processing ability. So really weird dynamic. I don't know how PayPal does that, but
Very weird. There's a lot of money slosh around in Silicon Valley right now,
mhm.
wanting to lend to merchants. So,
Yeah, yeah, exactly.
well, Maytab, this was awesome having you, man. A fascinating discussion. I feel like every time I do one of these, it reminds me of Patrick O'Shaughnessy's phrase, "This is who you're up against." And as I talk to you, like, holy crap! Like, if you want to do distressed ecom, this is who you're up against. So you better be good. So thank you so much for being here, man. This was super educational for me, and I'm sure for our listeners. As we wrap up, where can people find you on the internet? Where they find you, Karta? Is there any way they can help you? Whatever you want to say.
Yeah, our site's just cartaventures.com. I'm on LinkedIn and Twitter, but prefer LinkedIn. I know a lot of the listeners love Twitter, but I don't know. I've had a really good experience with LinkedIn. I love it, and I'm really fast there. So
I think you're the only 28-year-old on LinkedIn. but that's great.
Probably.
Well, Mehtab, thanks for being here, man. This was awesome.
Yeah, thank you.